So today will be the first time I'm having a repeat guest on the podcast, and I'm very pleased and excited to say that this is going to be Christiaan van Berg from JobJack. And the main reason why is because since the time that we last spoke, not only has he doubled the revenue of the business, doubled the customers, doubled the number of users, but he has also raised his pre-series A round. And when I say he, obviously mean him and his co-founder Hein, as well as their leadership team, investors, etc. And the reason why I'm giving that caveat, because I know he would like it if he gives everyone credit as well, but him specifically, I'm chatting to Christiaan today. And especially now in the time of this VC winter, when it's very difficult to raise funds, and also specifically for businesses found product market fit. Very curious to find out the story about their $2.5 million pre-series A round.
Ultimately, I just want to kind of give across that the measure of how you are growing as an entrepreneur and the size of the startup you're making, because I think there's so much emphasis placed on scale up and how much are you raising now, and yes, the PR is cool that comes with it, but ultimately kind of focus on the value creating for the people around you. If you're building a valuable company, people are going to want to invest in it anyway.
Welcome to The Founder Files, the podcast that's like eavesdropping on a conversation with a successful entrepreneur over a fireside chat. Join me, Cameron Coots, through this unique experience of unfiltered stories and insights from scaling founders around the globe as they share their ups, downs, and everything in between. Christiaan, welcome back to the Founder Files. You're the first guest that I've had here on a round two, so I'm very interested in this conversation for the sake of the listeners and watchers. If you want to find out more about Christiaan, you can obviously listen to the first episode that we recorded together. So I think we're going to skip a bit of the preamble here because that content already exists. But I mean, Christiaan, a lot's been going on in your life, a lot's been going on in JobJack since our last conversation, but also for our listeners, too long, didn't listen, don't want to go back to the first episode. Do you mind just quickly summarizing JobJack, what it's all about, and how life has been since our last conversation?
Cool, Cameron. Thanks so much for having me back. It's always a privilege chatting with you, and when we get to deep dive, it's always I'll walk away much rewarded from that. So thanks so much for having me back. And just as a quick overview to those that are listening, JobJack is in essence a platform that automates the entire entry-level recruitment process. So that speaks to positions that don't require tertiary qualifications, right? Qualifications above matric or more than about 2 to 3 years of work experience. And so we automate that for the job seeker and for the companies that we. So really kind of bridging the gap for those that need it most. And we do that at scale across South Africa. Just for those that don't know me as well, so I'm a husband, a father of a 2-year-old busy boy, but he keeps me super young, which is just awesome. And we live here in Cape Town, and it's been an absolute treat building a company and a family at the same time. Learning some really cool lessons. What's happened in the meantime since our last conversation, JobJack has grown. Our team, I'm actually not sure where we were when we last chatted, but we're sitting just shy of 50 people. So it's growing. You start looking at those levels of kind of management and how to set that up, how to enable, how to grow, how to equip, and then from a just traction perspective, we've doubled our revenue in the last 12 months. We are, I think, doubled our signups as well. So I think we're sitting just shy of 2.5 million registered job seekers, and generally across the year grew at about 2,000 new signups per day. But I think last month we averaged at over 5,000 new job seekers signups a day, which is amazing from an accessibility perspective, but super sad from an unemployment perspective, right? And so that's obviously a core part of why we're doing what we're doing, is to create accessibility and affordability to these opportunities. But then comes the part of going to get those opportunities and streamlining that process, not only for the job seekers but for the companies as well. And so that's kind of it. We moved new offices, so that's what's behind me as well. And we just completed a fundraise, which should enable us to grow, and I think that's what we're gonna double click on a bit more in this conversation.
So awesome, Christiaan. Yeah, I mean, the fact that you've doubled the business, both in terms of users, in terms of revenue, you've got your pre-series A. I mean, like, that's the main thing that we want to chat about today. And then obviously the fact that you are growing a business and building a family at the same time. But that also, the way that you explain that also highlighted another reason why I love having conversations with you, because you are one of my favorite examples of a person that really just walks the talk in terms of a gratitude practice. And that was a primary example there, in terms of, you're so grateful about the fact that you're able to build a business and grow a family at the same time, or grow a business and build a family at the same time. And a lot of people you speak to is like that, well, that's the reason why I'm exhausted. And for you, is like, that's why my life is so full and rich with meaning. So just, I want to point that out there as a little psychological tidbit to anyone listening and watching, that gratitude practice really works. But look, I think getting straight into it is the main question that I want to unpack, because from my perspective, a lot of founders treat fundraising as a goal in and of itself, right? But from my opinion, and I think many other people's opinion, is raising funds, and especially if you're getting the money of other people, they must be there for a very important reason, in order to help you achieve your strategy. It's resources that you're getting, and probably a team, or it depends on the kind of investor that you've got, but it's helping you move towards your strategy. Now, what I want to understand is, in this situation where you've doubled revenue, you've doubled users, you're growing in a year, you're so rapidly growing. And even in the preparation for this conversation, you're saying, like, if we signed 3 more deals, we actually wouldn't have needed the capital. Why go ahead and still raise?
Yeah, obviously, each business is going to operate differently, right? Each business has a different strategy. Each business is completely unique, and so our model really only works at scale. It's a go-to winner takes most, kind of land grab model, if you will. Right? A lot of LinkedIn's is not going to work. Even something like kind of looking at Facebook, right? It's everyone needs to be on there for it to actually add value. And so hence, kind of to kind of just quickly explain our flywheel. If we get a lot of job seekers, which we're getting, right, it enables us to get more jobs. So we're servicing just over, or close to 5,000 employer sites across South Africa, which does enable us to get more jobs, which enable us to get more job seekers, etc. And so that network benefit really kind of feeds that entire loop. And so for us, it's we need to kind of go get it all. And I say that with a lot of caution and a lot of respect and a lot of admittance to the fact that can become very greedy if approaching it in the wrong way, right? And we feel that we are the right people to go do that, because our heart is really to add value and to really to create hope and to provide opportunities for those that need it most.
And employ the world, right?
And employ the world. Cameron, thank you for remembering our vision. And so our chase is really to get there, because otherwise another player might do so, and they might exploit those that are really desperate. And so hence a raise. Regardless of our revenue growing, and obviously if you look at specific deals that come in later, you like, oh, if we only held out a little longer, then maybe this deal would have come through, but you don't know. And so maybe it's the accountants in us. So again, for context, my co-founder and I are both CAs, which sometimes helps and sometimes doesn't at all. But so for this, you raise with regards to expecting the best but preparing for the worst. Right. And so we know that where we're going is going to need some capital injection. We are a completely different product and solution to what's known out in the market. So part of that is educating the market, which sucks for any business, but it breaks open so many opportunities and creates so much revelation and realization. And so hence us doing the raise, we kind of have come to a point where we really feel comfortable with the fact that we found product market fit in SA, especially with a few industries. And so now it's how do we duplicate that in different industries across South Africa, but then also start looking towards Africanization and the borders there beyond it, and that'll come in time. I mean, again, just to clarify, our prioritization is still with this race is still the South African market. And they're after, starting to dip our toes in the rest of the African markets on the back of our current clients, which really is a massive benefit. But to get there, we know we're going to need some more amazing brains, to join our team. And unfortunately, nowadays, we are not just competing with other South African companies, right? You competing with international, salaries. And so that's something that comes with the territory. If you really want to build a global company, right, we need to start thinking long term. And yeah, just being able to equip our team to really build not just what works here in SA, but that's something that's going to work, when we 10x, 100x, whatever we're doing here. So that's kind of the first step. And second, speaking to, why raise? Why not just, and obviously then you start speaking to types of fundraising. And so in our case, we did an equity round. And with that comes amazing ownership of other players that have experienced growth in ways that we can only tap into, that we can only dream of at this stage. And so with that comes not just monetary capital, but intellectual capital as well, mentoring, kind of resources as well. And so something we went out to as a front of mind was investors that are really impact focused, because they need to see the longer term picture. It's not a short, get in, build for valuation and get out, because you're going to build the business in a completely different way. They needed to have known that we are in it for the long run. And if you pursue purpose, then profit will follow, right? And that's an understanding that we hope, and we are quite definitely kind of, went in from a narrative with the new players on board. So super key, not just for the money that's come in, but for the mentorship and advice and the doors that will be opened with the partnership. So yeah, my long first answer to the question.
No, but that's amazing, and thank you for all the context. I mean, there's just so many signals on what you've said around, if you do something for people and solve a problem for people, money will come, right? But if you go and chase money, then you're probably not going to get anything. And also your points around mentioning it's a land grab, but also your own values and worldview and responsibility around that is the fact that, like, there's a quote that I like that I got from another guest on the podcast called Howard Mann, and the only thing that grows for the sake of growth is cancer. And I think the fact that you're very intentional about why it is that you're wanting to grow, but also knowing that there's other players in the market that might have different intentions or even business models that might not be as beneficial. You mentioned your flywheel, you mentioned the building of your network effect, and I think that's all really awesome. And then finally, just your points around the fact that it's, again, going back to the point that I was making, that getting the capital of your fundraising isn't just about, isn't just a goal in and of itself. It's the resources that you need in order to fulfill your strategy. But what that also comes with is, what are you getting with that capital? Like, who are the people coming on board? Who are the investors? What access are they going to provide you? What experience are they going to provide you? What skills are they going to provide you? Because, the nature of being an investor is the fact that we don't, especially at this stage, we don't want passive investors. We want active investors that are really going to believe in what we want to do and help us, shoot the lights out, but also keep us focused and keep us clear, keep us profitable, keep us sustainable. But there's obviously one point that I really want to dig into, right? And you mentioned product market fit, this elusive term that everyone chases after that means different things for different businesses, and like it's how it's measured is constantly up for debate. But also at the same time, you got a pre-Series A round. And I know that the South African investments in VC market is very different to the global one. But usually, from what I've seen, is when you've got product market fit, it's like, okay, cool, Series A, and let's continue. So I think, let me ask you these two questions. Product market fit, how do you know you've achieved it? And then secondly, why pre-Series A and not Series A?
Okay, cool. So yes, 100% product market fit is such a loose term, right? And again, I think it's defined in different ways, right? If you're comparing us to a global player, then we've not yet gotten product market fit. We've gotten a niche product market fit, focusing on our specific industries in South Africa. And I would be comfortable to say that we hope we've established that, because we've been able to close X amount of, clients, servicing over, close to 5,000 sites across South Africa, employer sites across South Africa, with basically myself, kind of doing the deals, running sales. Right, we've just started building up our team, and they're amazing. They're going to do so much better than I ever could have. But that speaks to kind of, actually just it being so easily adapted. And we have companies starting to come to us to ask us, cool, they've seen what we do, they sell to us. We want
a great sign of product market fit.
Yes, and that's generally what we see as product market fit, right? The market has found a fit to our product.
Yeah.
And we're able to service our clients and the various clients in the same type of way with our product. So our product fits into, specifically at the moment, the retail larger corporate market. And so for that, we have product market fit. If we start, venturing out into different industries, you're going to have less of a product market fit because it depends on what your market is, right?
Exactly.
But again, from a strategy or a growth perspective, you define what is your market and you go double down on that, where you have fit, and you start dipping your toes, you start expanding slightly, but jointly to those that, kind of run in comparison with, and then you start adapting or growing your product so that you are fitting a wider market. And so what this raises, obviously, looking for is widening our market so that our, expanding our product so that it fits a wider market. And that doesn't mean product diversification. It doesn't mean, kind of diverting. It just means our same product that, kind of adopts various types of entry-level recruiters, just in small nuances. And it's usually more in the way that they are serviced and want to use a system than it is the actual features in the system. What we've come to know is that we are servicing a very specific type of entry-level employer. And so the product is a product. We're not building custom features for custom clients. There might be some nuances. Should we go into a different market that's big enough? Let's call it call center. Let's call it, insurance, etc. But ultimately, we want to get to a point where the vast majority of large entry-level employer industries are able to utilize our system as is. And then obviously from there, you start looking at other markets, as in geographical markets. So yes, that to your product market fit question.
So sorry, before you continue, and also now I'm going to just ignore my second question. I'll ask it when we're ready. But going there is like, I really like the emphasis on market, because like the point is product and market depends on the market. You build a product for a market. You don't try and build a product and find a market for it. And you've really nailed it in the retail space. And you're talking about having these subtle nuances and different approaches towards different users, different clients within different markets. Can you be a bit more specific about what it is that you mean? Because obviously you nailed the retail space. What are these other markets or industries that you're looking at, and how does your approach and product need to change for them?
Okay, so let's take just a general concept around SaaS, right? Software as a service. If you're servicing corporates, it's not software as a service, it's software and a service, right? And so that's kind of the first point on these nuances is you've got a product, and in theory, retail should be using it the same as call center, should be using it the same as insurance, and but they don't, right? Because they just operate differently. And so one, you need to speak to kind of how does your customer success operations team and even your sales team sell it in a way that speaks more to the way that they see recruitment happening. But then two, if you start speaking about nuances, it's maybe something like a call center would prefer to hear how someone sounds maybe before they do an interview. So you have voice note recording functionality, and that can be drawn across to another industry as well. But it's that small nuance which it's really going to sell it to the call center, but it's something you can sell to retail as well. It's something you can sell to insurance as well. It's something you can sell. So again, really looking at building what scales and what services, multiple markets, but to kind of then go, piece by piece, and something that's, maybe completely far removed is, would be mining or agri, because it's a market that maybe interacts way more over WhatsApp. And WhatsApp, we could do that, but the margins are much lower in that market, and so we're going to need to spend a lot more on communication over WhatsApp with the job seekers, and so it just doesn't make sense for us at this point, because it's still going to use the same base technology, but it's going to be a completely different service from their side. Even listing certain short list aspects, and I know I'm getting into applicant tracking system and HR system lingo here now, but some industries prefer to do a third-party check before they do an interview. Others do it after an interview. And so just those small kind of nuances that easily can be toggled on or off and can be switched across industries. But for retail, like 90% of the time, it's going to work like this.
Sure.
But then just a small little change is going to open up the whole call center space for you, because they're just going to receive it and use it in a different way. But you need them to ultimately all use it as effectively. And so when I'm speaking to the nuances of product market fit, then I'm speaking to that. And just a disclaimer for if and should our product team listen to this, I'm at the mercy of your guidance, and apologies if I'm saying anything incorrectly.
I love the humility. But also, I mean, like, and another whole element to add there is the fact that the predictors of performance of the people that you're recruiting are different depending on the industry. So, for example, if you're looking at something like manufacturing, mechanical or spatial reasoning becomes an incredibly important skill. But then in terms of retail, it's going to be verbal reasoning that's going to be more important, right? And so how you assess for this, how you build this into your job analysis, how you build that into a technological product, and reducing the effort required in a recruitment process as well from your customer side, not necessarily your user side. Like there's a lot that kind of goes into that, and having those competency frameworks is critical.
Yeah, 100%. And so for context, for those that don't know, so we build our own psychometric assessments, or have built for the market that we're servicing. And to Cameron's point, yes, then you need to start looking at how do you expand, and how do you emphasis on various qualities that speak more to a specific industry. And so yes, 100%. That's part of those kind of confidence aspects that you walk to a new industry, and you can tell them, we've never serviced someone in your industry, but this is why we know without a shadow of a doubt it's going to work. And to get that first player, to get the second player, to get the third player, and then kind of you're rolling on. And so that's generally how we've approached it. And I mean, in all transparency, we've made mistakes in that as well. I think 2 years ago, we kind of had a spray and pray approach, right? It should work for all industries, so let's just like bombard, them with these cool marketing or sales campaigns. And we got a lot of interest, and we even piloted a few. But I mean, from a CS consistency and process perspective, and onboarding them, and kind of then converting them, it just fell apart. And so luckily, no bridges were burnt. It was more, thank you so much for testing out this industry with us. We'll get back to you when we've kind of,
clever.
And so just, and just for the past year, we've kind of zoned in and focused on what we know our niches are, and then kind of identified where we want to start dipping our toes in. And so then obviously that grows, and you can start dipping your toes in the next pond, et cetera, et cetera. Sooner or later, you create an ocean, and then you learn to swim.
100%, man. Yeah. And also the fact that you mentioned the customer service and experience there is obviously such a critical point, because another problem I see in people chasing product market fit is they overemphasize customer acquisition over customer retention. And the problem is that if you haven't niched down your market and really thought about the value that you're adding to them consistently, product market fit is actually questionable if you're not having a high degree of retention and keep coming back, right? And I think that's the critical point. Okay, so without going into a whole conversation just on the like, I guess, theory and the practical application of product market fits, let's go back to that second question, right? Why pre-Series A when usually given the fact that you at 50 people you got product market fit? I mean, this sounds like a pretty Series A kind of business, but why? So why pre-Series A, and how? I guess.
No, I mean, great question. And again, even product market fit, any terminology for any race is so open-ended and so subjective. And I mean, to give you guys an idea, we had investors calling this a Series A plus, and investors calling it a seed round, some a seed extension, some then obviously pre-Series A. And so again, it's semantics really, right? But how we wanted to approach it is, if we are thinking long-term, then you're thinking there might possibly be future raises as well. And so to set yourself up to a different way in which valuation is looked at and growth is expected from a different phase. you are more favorable, kind of from an investor perspective, it's more founder favorable, or even figuring out and kind of growth favorable, when the terminology is closer to, the start. Whereas in, kind of, so because if you're gonna compare what's generally seen in Africa as a Series A, which yes might suit more where we were or as a business. I mean, the expectations of that are what the expectations are of that at a for an American company maybe. And so if you're going to start looking at your next raise and you start looking at foreign investors, you're like, we did our Series A 2 years ago, and so we're doing Series B now. And then, I mean, your expectations are something completely different from what that market is versus what our market is, right? And so, so there's this disjointed kind of, I don't know, feeling and expectation now and future in raises. And so we reckon just from a creating more room for future raise with the right type of expectation at where we guess we're going to be at that point, because at that point it'll be, probably closer to some geographical expansion. And then you get closer to, okay, cool, it's working well. Now we're really starting to kind of grow in the more, offshore foreign investor perspective of what a Series A is. And so that's kind of why we landed on pre-Series A. But again, like it's really a semantic and open for interpretation, but it's a safe one, and I think that's why we went in, because it indicates enough growth. You're not calling it a seed extension, you're calling it a pre-Series A. You're not calling it a Series A, you're calling it a pre-Series A, right? So yeah, for what it's worth, and for the little time that went into kind of just cementing that's the explanation.
Well, and once again, it's very on brand for you and Hein, because both very strategic and very humble. So I think that's a great reinforcement of that too.
Thanks, Cameron.
So, all right. So obviously, I want to know a lot more about the investment itself, the investors that you brought in. But I mean, there's also another thing that I want to bring up now. It's a BC winter, and I think and this is another indication of maybe a harbinger of your own success, is that a lot of some of the greatest businesses that we know, for example, Airbnb, I know there's a list of them, but I can't remember them for the life of me right now. But during poor fundraising times and other investment winters, those businesses that managed to raise have proven to be quite successful over the long run. So I think in this time when there are so many businesses struggling to raise funding and so many VCs struggling to make significant exits as according to their mandates and targets, just how did you manage to raise money at this difficult time?
So it's not the most favorable time to have raised. I mean, we got multiple kind of players saying, only we'd approached them 6 months ago, or kind of we were where we are, and etc. But I mean, you deal with the hand you dealt, right? And each kind of space and time offers its own opportunities, right? I mean, you've read your Outliers, by Malcolm Gladwell. It's really kind of a not a luck of the draw. It's a scenario where you find yourself and you need to make the best of it. And I think different scenarios are going to shape and form your character in a different way. And life is great that you can make the best of it. So that being said, we were super fortunate enough, and I think like it's really kind of what we've the situation we found ourselves in is really testimony of the hard work of our team, right? We've been able to show traction across a few years, post COVID, and continue to grow in that, not because, and again, like Hein and my bald head and beautiful mustache he has a beautiful mustache for those that don't know, not me, can only take us that far, right? The proof is in the pudding, and so it was quite not easy, but it was kind of quite evident to any investor that we chatted to that the traction is there and the growth is there and the opportunity is there, and I think that in and of itself helped a lot. I think too, it really helped that what we focus on is a massive social impact issue in South Africa, and in a lot of developing countries. So there's something that speaks to that allocation of funds quite freely. especially from a mandate perspective. And that's why we went to go chat to those types of VCs. We really only try to zone in on those that are impact first. And then third, and I think we sometimes take this for granted, and I know and that's why it's such a blessing, is Hein and I obviously come from an accounting background, and so for us to be able to showcase, the historic figures and the forecast, is something that speaks to these investors. And I say we have an amazing CFO that is just, she's an absolute machine. And so kind of, really being able to give through what we know is there, but on paper, it speaks to the investors, right? It makes it a much easier conversation. So I think those three factors are aspects that really helped us in this time. It didn't get us the deal, that we might have gotten six months beforehand. But that being said, we grew more in revenue 6 months, post. So it's just, it's really kind of really just fortunate enough that we were speaking to the right people. Also, and I think quite important, and I think this is something that's, that's said time and time again, is we started the raise process when we didn't need the funds, right? Again, you spoke to kind of me sharing point if there are one or two deals that are looming that should be getting anyways necessary, kind of looking forward, but again, raise when you don't need it, because otherwise you're on such a back foot entering into any of these conversations. If you can sit and you can say, well, we don't really need this, but we want to grow, then investors are like, oh, well, I don't want to miss out on this. And usually then the ecosystem is so small that you have 2, 3, 4 people that you just spoke to speaking to each other, and then it's creating a bidding war or a sense of FOMO, and then the conversation becomes easier. And then if you have an amazing CFO that creates a data room that kicks ass, then it's just helps all the more.
This podcast is brought to you by Metavolve, for founders who are committed to scaling their business, but are tired of wearing 12 different hats. For founders who want to focus on their next stage of growth, but are worried about their customer and employee satisfaction. Metavolve helps you build the structures, systems, and management team that you need to elevate yourself out of operations. It's time to free yourself up to focus on growth. Do it now with the entrepreneurial partners that put your customers and your people at the core of your scaling strategy. Metavolve, empowering leaders, evolving businesses. %. So obviously you mentioned now is like if only you'd come 6 months earlier, and if you had gone 6 months earlier, it might have been different. What was your approach towards, especially because you've got the approach where you don't need necessarily the capital, right? So what was your mentality going into the raise? Did you have a cap on the equity that you're willing to give away, and you were going to raise however much, you mentioned the bidding war, however much you can get according to that, obviously within the category of the right investor too? Or did you have an amount that you had in mind, and you've had to give away more equity now in the VC winter than it would have been 6 months before, but because valuations have changed, because the investment market's changed? Can you just unpack a bit about that kind of the variance in pulling those two levers of the actual fundraising amount and the equity you're giving away?
Cameron, I love these strategic questions because they are obviously a way that you need to approach this, right? So generally there's a kind of a fixed amount that you like of equity that you generally give away in rounds like these. I'm not going to speak to that exactly because everyone needs to go do their own research with regards to kind of how this looks. And so generally there's not a certain amount that you kind of that you look at, kind of you're going to give away this much, and you're going to chase how much ever you can raise, and giving that amount away. That being said, we knew there was a specific amount that we wanted as a minimum, but also a maximum. And I mean, to previous point, I think it really spoke to the investors we chatted to, giving them quite a fixed amount and a forecast with that amount as to what we're going to do with the capital. Because I think, as you mentioned now exactly, you either go in with a specific amount that you want, and you're going to try to give away as little equity as possible, or you're going to go in and say you're going to give away this amount of equity and let's see how much you can raise for that. But that leaves the investor thinking, you just want to take my money, or you just want to keep as much to it for yourself as possible. And the right investor understands that you as founder need to kind of maintain as much as you can for as long as you can, especially if it's going to grow as big as they hope it's going to grow, right? Because there's going to be future raises. And so that one speaks to approaching the right type of investor. And when you approach the right type of investor, then you can start playing, and I want to say an open hand. There's always, especially in a start conversation, but then you go in with an informed, hey, this is the minimum amount we know we need to get to the new phase, but we don't want more than this, because it's just going to be an inefficient waste of capital. It's just going to sit there and it's going to be underutilized. And we know that more companies fail because they have too much money and grow too fast than there are companies that fail because, they run out of money. And then with that, you put on the table what is a very reasonable and market relatable amount that you give away, because then it's a very fair, deal that you're putting on the table, which no one has their guard up. No, you're not going to get a term sheet 2 days later, which is like completely different from what you expected. And then there's already kind of a distrust and a mismatch from the get-go, right? Obviously, not naive to the fact that both our businesses, both kind of, there's this kind of space between, what's going to best suit them and what's going to best suit you. But the more fair you go into it, the more kind of, just reasonable and dual benefit you're going to go into the process with, the better it's received and the less time you're going to spend on the back and forth of the negotiating. There's always a win for a competitive person, like us, or in sales, where you like, okay, great, they agree to like this amount more, this percentage, less, or whatever the case may be. So you're always going to push a bit, but you generally going to go in, and what we did was we went in with the range for both, right? So a range for, so we're looking at raising around this minimum, maximum, and for that we're willing to give away between this and that. And that opens the conversation to flow much easier, because then they don't feel like they're not going to come in with something way below, way over. And it just kind of sets the tone from the get-go in the right way. And again, if you're going in when you don't need, then you've got a much better foot to stand on, so that they know that which you're coming into, you're serious about. I don't know if that answers the question.
No, yeah, more so than what I was hoping for. It's, either way, it just sounds like you were super prepared for your raise, and you knew exactly what you were doing.
We were. So we blessed with some really cool, current investors. And when we told them we're going to go raise, they were like, "Are you guys sure?" And we're like, "Yes." And said like, "Okay, well, pitch to us. Kind of approach us with this. If we were willing to kind of, give it a stab and feel this is something that can be put out into market, then it should be ready." And so sometimes a little onerous, because you're like, "Oh, do we have to do it?" Okay, but then I mean, it's
that's
so
what they're there
valuable,
for.
right?
It's good
And
governance.
exactly, that's what and so by the time you get out and they've prodded holes in it, far and wide, you come in there not fireproof whatsoever, but at least more confident in knowing what you're doing. And I think that's what investors want to see. They want to see, like, sure, you're still figuring it out, but you're confident in what you need to get to the next step to make them more money.
100%. Okay, so you mentioned obviously the word forecasting, right? Which I love that, because in entrepreneurship it's really hard. So but what it actually comes down to is a strategy for how it is that you're going to be utilizing this capital, right? And instead of asking a very sophisticated question around this, how are you going to spend the money?
Sorry, I'm laughing because it's such an open-ended question, but it's the important one. So what we you might have seen, Cameron, this yesterday, that we've launched 2 new roles, so head of sales and head of marketing, because we're now in growth season. And so again, I mentioned in the beginning, kind of drawing the right talent and ensuring that your current team that is with you is being rewarded for what they're doing. Kind of you've come out of this phase where you've pushed on and you've kind of kept up with growth, and you've done with what you can, and you've pulled in talent for passion, but now you're getting to this phase where you're becoming a growing business, and so you really want to, one, attract the right talent, sure, but two, and more importantly, you want to retain, the right talent. And so that's, kind of quite a big aspect of where things are going. Then you need to start looking at stable infrastructure. If you're sitting at 6,500 signups a day now, and 2.5 million people, and you're wanting to double, triple, quadruple that, then you need to start looking at a system that's not going to, shut off like most e-commerce sites do on a Black Friday. You really want to start looking at the long term, and part of that is starting to set up for, whether it be internationalization, whether it be teams that are not all sitting at the same site. So we're really kind of realizing what it's going to take for you to get to a point where those jaws of life are starting to close. And yes, a lot of it is speculation, but the longer you get into your journey, the more it's informed speculation, right? So you go look at historically, what have you done, and then you estimate, okay, well, if we switch on, this tap, close this one, add to this one, then theoretically or historically, that should add to X, Y, and Z. And so, where we are at this stage, we know a vast majority of capital still needs to go into a stable, maintainable base, and then quite a bit into growth as well. But from there, you can really kind of switch on the growth that can scale. So that you don't, build a Jenga tower with pieces missing at the bottom, and eventually it's going to topple. But you're building kind of a pyramid that just, strengthens as you go higher. So that's generally, in a very vague answer, what we're going to do with the capital. Talent is quite a big one. Talent is where the majority of the funds are going to go. If we want to employ the world, it's going to take a nice team. And
walk the talk, right?
Yes. So our investors tease us every now and then, like, "Hey guys, just because it's your vision doesn't mean you guys have to do it." And yes, I mean they're so right. But again, like it's a constant tension between drawing for passion and rewarding that passion as well. So it's something we're still learning of. Like, by no means have we figured it out, and we still kind of running into learnings on a daily basis. We've got a really graceful and patient team in us figuring this out as founders, and so we're super thankful for them as well, and learning and experiencing the journey with us. The 45 minutes is for learnings as well, which is cool.
100%. So, well, I think one thing you'll like, it's reminded me of around the point of talent, and there's just a principle and like mental framework that I like to use, and it's the talent equation of competence, commitment, and contribution. Think about like a Venn diagram, but also a multiplication between each of them. So competence is how well can the person do the job. Commitment is how committed are they to the organization and its success, and contribution is to what extent do they feel like they're getting a sense of contribution from the work that they're doing, and the fact that it matters. And this multiplication, if this person's a 10, a 10, a 10, this is the most engaged and unbelievable employee you're ever going to have. But the point is, you can have someone that's, for example, moderate competence, but high commitment, high contribution. Like most people that usually join a startup, right? Is like their competence there because they're a Swiss Army knife, not a specialist, but they're amazing talent to have in the business. And now, but you want head of sales, head of marketing is like, I need 8+ on all three of those things. And that's the alignment, and that's how you've got really good talent. But anyway, getting out of theory and principles.
No, that's cool. I'm making notes as we go, Cameron. Thank you.
Go for it. Well, it's a good thing this is also getting recorded, right? So you can always go back to it.
100%.
So I think that the last thing I want to actually ask you about now is just the team of investors, right? So besides obviously the capital, you mentioned impact investment being important, but tell me about the investors that you brought on board. Who are they within the extent of what it is that you can share? And what is it that they're bringing to the table that you think is really adding to your business, adding to your board, and adding to the perspectives that you have at a very strategic level?
Cool. So, I mean, it's public knowledge now. For like a long time, we were like, we're closing this raise, and people were like, oh, who are? And we're like, I can't really say it. But I mean, it's out in the news. not everywhere. We are by no means that famous, but it's out there on LinkedIn. So the two players that have come on board is Next 176. So it's a relatively new VC leg of Old Mutual. And then there is the Michael and Susan Dell Foundation. So you guys can think of the Dell laptops that you have. Yes, the Michael Dell that started that. He and his wife have an amazing foundation that look at impact. Primarily, they were stationed across from America, South Africa, and India. And they are, they are looking at some expansion as well. But so really kind of diving into the impact in markets that are, kind of really underserved. And so what's been amazing from both these institutions and so just a quick context on Next, and I mean, everyone can go check them out, but their mandate is really to how do they serve the underserved market? How do they enable and connect the underserved market, which is Africa? And so it's such a cool kind of long-term, vision, and their name, comes from, it was established when Old Mutual was 176 years old. And they were like, how does the next 176 years look like for Old Mutual and the impact that they're making, which is really cool, because you think Old Mutual and you think big corporate, but then you think of cool, how does the next 176 years look like? And the fact that they've, really kind of zoned into kind of this, VC that's really looking at building impact for that. You think of the advantage of having massive, legacy knowledge and wisdom and connections, and the eagerness and hunger for, duplicating, future impact in really cool, innovative ways. And their team is just the most amazing people that are so, switched on and so therefore for helping and enabling their investee companies. So really privileged to be part of kind of what they're doing. And super excited to kind of be part of the investments that they kind of looking at and making and the impact that they want to make across Africa, but kind of speak of why we kind of had a chat to these parties, and it was kind of a mutual approaching each other from last year, with us kind of being a little on the we're not ready yet. The first time we chatted with both, we're not raising yet. It's not a thing, but that's so beautiful about, getting connected to the right type of people, because they're patient. They 100% understood and respected where we were. And
it's also a relationship
ready,
at the end of the day.
100%. So when we were ready, I mean, it's a no-brainer to be sending them our pitch deck and even asking for feedback on it, right? And then kind of ultimately engaging in these conversations with players that are focused on impact, but not in a fluffy way, because it can easily become that. And we did speak to one or two that really are just there for social impact, and all they want to see kind of is just the data around that, and I don't really care about the commercials behind it. And then obviously on the other side, you get people that are just, okay, how can we exploit the data that you guys are doing? How can we kind of upsell X, Y, and Z? And we're not naive to the fact that if we have the right types of products in the future, it's something that can unlock so much benefit and hope and value to the market that we're servicing. But by no means is it our focus, in the short or even semi long term.
So I was just laughing because I love the world of startups, because as you look down, there's a dude on a scooter that just went down your office behind you, and I think that's amazing.
The new offices, we're still growing into it, so there's so much room for activity. So what really kind of just stood out, of these two players specifically was three things. So one, they impact focus, right? Like they understand the long-term vision to employ the world and the value that it brings to those that need it most. Two, they really switched on from a commercial perspective. Like they really understand that to get where we need to get from an impact perspective, we need to approach this in a very sound commercial way that's going to create, great exit for them when the time comes. And so, no one's naive to that, and everyone's really aware and zoned into how do we do that in a very effective and lucrative manner. But ultimately to get to the impact, right? And so again, that, chasing, or pursuing purpose and profit will follow. And so, so that really kind of spoke to us in, wow, these players are really going to add a lot of business value, and not just drive us to, give them through, stats for impact, which they want as well, because it's just part of their mandate. So it's such a cool combination of what we need and the wisdom we need. And then three, both are amazingly founder focused. So they really value and understand we perceiving and understanding and respecting kind of the way that we've built the business and the way we want to build the business. And I think we almost at that stage where, kind of if you look at angel investors or even seed investors, generally they back the jockey. But at this stage, you start looking at, okay, well, is this the right person to take it forward or not? And so the feedback or the feeling that we've gotten, the perception or direct, is that they really see kind of, the vision that we have, and they really want to enable us to drive this forward, right? Whether it's enabling us or in any way, which way, shape or form. And so I don't think that's something that we saw far across and wide, for suggestions within the agreement, for, just aspects that spoke so much to their seeing this grow long term, right? In the way that we as founders need to be motivated and operate, and grow our team and run our team and lead and motivate our team. So that was just really kind of the three aspects that really stood out. Besides that, I mean, they're going to bring a wealth of just intellectual knowledge and support, which is really cool. And yeah, I mean, we'll see where future raises bring us from with regards to kind of their encouraging and support of that as well. But those were the main aspects that we looked at. And approaching investors for this round, we were quite strict on the mandates that they need to bring as well, right? Speaking to them, doing a due diligence on you, just as important that you do your due diligence on them as well. And they respect that, right? Any good investor appreciates you doing your homework as well.
Yeah, you're being a good director of a company.
Exactly, you're being a good steward of that which you've been given. So it was really kind of cool just going in with a clear mandate and a very open, communicated one, so that if you phoning up someone to meet, there's already a no, from their side or your side, because you're quite honest and clear about how you run the company, what your long-term view is, and kind of what our personal mantra is as well. So that was a really cool learning for us and a really, really valuable experience. We didn't feel like we stole a part of our life. A lot of times you're going to raise, just put away 6 to 9 months of your life, because that's all you're going to eat, sleep and breathe. We didn't experience it that way at all. We had a very healthy 2 to 3 weeks of conversations, amazingly engaged conversations, very valuable. And we were blessed with an amazing CFO that could kind of run the rest of the journey with us, as well, whether it be in the data rooms, or kind of, the due diligences, the questions, our leadership team kind of, speaking into that as well. So really rewarding experience for us. But that being said, do put out 6 to 9 months of your timeline, your cash life, for that as well, because that is how long it can take. The initial, process took super quick for us. We were super blessed to kind of, have almost the majority of aspects done within 2 to 3 weeks after sending out our pitch deck, commitments and we were like, oh, this cool. And then, it just takes so much longer than anyone expects. Investors, outside players, inside players, it's really kind of just something you really need to think about as a 9-month, more or less, process.
Yeah, well, unless you're JobJack. So, Christiaan, thank you for sharing so openly, so humbly, but also so potently and powerfully. I've got a lot of respect for you, my friend. So thank you for sharing your story. I think the only thing I've got left to ask you is, what's the one thing that I haven't asked you that I should have asked you that you'd like to answer now?
Karen, it's such a blessing chatting with you. I think the one thing you haven't asked me is when can we chat again, because I always like chatting with you. Obviously always would love to chat with you again, but I think something that I just like to kind of bring up and just drop a point of, and I know I'm speaking from a privileged platform because we closed the race, but is to not place the value of your startup's growth on whether you are raising or whether you have done a raise, or whether you're even raising at a certain valuation or not, because ultimately you need to build a business that creates impact, right? That offers value to people. And so in that, you need to really kind of build for a case where you might never raise. Right, and it's rich coming from me because we've done a few raises. I do realize the irony in it, but we've really tried to approach it in the fact that our company will still carry on and thrive even though we didn't do this raise. Yes, it enables us to grow quicker, and so we might grow a little slower if we couldn't do it, but if it took even longer. And there are some calculated risks. I mean, there are some kind of tight moves and corners that you have to navigate through. But ultimately, I just want to kind of give across that the measure of how you are growing as an entrepreneur and the size of the startup you're making, because I think there's so much emphasis placed on scale up and how much are you raising now, and yes, the PR is cool that comes with it, but ultimately kind of focus on the value creating for the people around you. If you're building a valuable company, people are going to want to invest in it anyway. But you shouldn't be reliant on your value as a startup, and your value as a person shouldn't be, reliant on people throwing money at you. Because in the most famous of cases, right, it wasn't so. Think of KFC. I think what Colonel Sanders went to, how many 900 and something places before the first person kind of said, shop, let's go. And I do a KFC bucket once a quarter. Love it. It's my guilty pleasure. So anyway, I digress. That's just something I wanted to kind of put out there is to really not lose heart, especially in this environment that we're in. If you need to zone down, but find value in the one life that you're changing, or the one piece of value that you're adding to a customer that wouldn't have gotten it elsewhere, otherwise, right? And again, if you're zoning in on that, then you're creating something that's of value. And investors will come if they need to or not. But focus on that, the value that you're creating.
100%. Christiaan, thank you so much for being on the Founder Files again. The first debut of a round 2. Man, and I'll definitely be in contact to make sure that we continue having amazing conversations. Congratulations once again on your raise. Congratulations on being an awesome person. And I can't wait to see the continued growth and success of JobJack.
Cameron, thanks so much for allowing me back on. It's such a treat, and thanks for having me share my story. I've still got a lot to learn, but hopefully it motivates some people to keep learning as well, and hopefully learn from our mistakes. Such a treat, and thanks so much for having me. Appreciate it.
My pleasure. Cheers. What an amazing story, and again, it's just both the humility, the candor, the honesty, but also the preparation and strategic foresight that Christiaan and his team has is really impressive. And I think that's the point now, is that, as we were talking about at the end, and the way I'd like to frame it is that, if you're a good business, it's a good investment. It's that simple. If you're looking for funding, if you're looking for investors, being a good business is the easiest way to really find investment. And that was proven, right? Not only with product market fit, and specifically in the market they've focused to choose on in South Africa and in the retail space. So obviously quite a niche customer segment. I mean, niche is still, a big market, but compared to being a job seeking platform, job posting platform, and a software as a service solution for recruitment for entry-level jobs, there are so many different industries that this can focus on. So the niching down into a specific market sector allowed them to achieve product market fit there, develop the concept, grow, get to about 50 people, and have that kind of track record of success that got them to the point where, if they'd closed a couple more clients, they wouldn't have had funding in the first place. Well, they wouldn't have needed funding in the first place, but they still chose to get it anyway. And a big part of that was, one, rather have the funding and not need it than need the funding and not have it, right? And especially when you are in a position where you are able to raise funds when not needing it, obviously your bargaining leverage is so much higher. So the way that you can get the investors that you want, you can get the partners that you want, and you can get the terms that are favorable to you, you're in an amazing position. And especially now in a time when it's so difficult to raise funds, doing all that makes it super easy to do so, which is why they were able to close their round also so quickly. And that also then leads into the type of investor you're trying to go to, because now if you are in a position where you're quite strong, you can now attach your vision, your purpose, your mission, your philosophy, your values towards the right investors. And that should always be done, for the record. But often a lot of founders can be in more desperate positions where they need the capital, and they'll kind of get the investor that they can get. But as Christiaan was pointing out, is that can often, pull or distract the strategy or the reason for the business existing. And so having the right partners is definitely an absolutely critical component. And finally, just from a leadership level, obviously it's embedded between him and Hein in terms of being CAs themselves, but having those financial controls in place, having that very good data room, having a very clear approach, and knowing the language and visibility of what VCs want to be seeing, and preparing that for them, and then also going and checking with your original investors, getting them to poke holes in what your pitch will be before proceeding, is just having this level of preparation where you're making the lives of your investors and stakeholders much easier by showing them what it is that they want to be seeing, and then you can just have a conversation. And doing all this, and yes, to his point, it can take 6 to 9 months to raise funding, but if you if you focus on being a good business, have a great team around you, pick the right investors, know exactly what you want out of it, and be well prepared in terms of what you want to give for them, it's not going to be too hard to raise funding.